Hey, what's going on everyone? Matthew from therighttrader.com back again with another stock video. We're going to be talking about the top dividend stocks, and this is sort of a follow-up video to the last one that I made where, I'm kind of looking at stocks that are somewhat on the safer side, that have a passive income opportunity with some high-yielding dividends, and that's why I'm making this video. By the way, the last video did really good. Welcome and thank you to all the new subscribers. If you aren't subscribed yet, make sure to hit that subscribe button, and let's get right into the video. So first up, we've got the Eaton Advanced Tax Managed Fund, which is a fund that actually does writing of call options on US indices. And this is actually a pretty common passive income option strategy. So that's exactly what this fund does, and that's why it's able to provide monthly dividends. So a lot of stocks pay dividends on a quarterly or yearly basis. This one actually pays every month. So right now the current yield is at 12%. Divide that by 12, it's about 1% a month in dividends that you're getting. So very, very big dividend. And one thing that I really like about this fund, although there is a little bit more of a higher risk, higher reward here, and that's the case for a lot of these stocks in this video, but overall they have proven to be stable for the most part. And I should also say, with that risk reward comes a lot of opportunity, obviously, instead of just your typical blue chip stocks. Not that there's anything wrong with that, but these ones right now are at a very big discount, and that's something that I'm going to talk about as well when we're going to look at the net asset value, which is the NAV. And this is actually how much the stock should be priced at based on its assets, which is $11.37, but we can see that it's currently priced at $10.06. So it's actually below the actual worth of everything it owns. And that is the best time to get in a stock and fund like this, is when the market price is actually below the total value of what they own. And you'll see in the past, for the most part, with a couple exceptions, they are supposed to be very similar in price, and often the market price is actually higher, as you can see in the last 2 years, than the net asset value. That's usually how it's supposed to work. And like I said, this is really when you're getting in at a good price, is when you can get in below the net asset value. So that's the NAV there. Also, one thing that I really like about the ETV stock is the fact that it actually survived the 2008 crash. So some people might say, yeah, this is the type of fund that's a bit risky. But if we look at the performance, it fully recovered from the 2008 crash, and getting in at that 2008 crash would have been a terrific buying opportunity. It's been stable ever since, with the only hiccup being what just happened now, which I see as just another opportunity like we had back here to get in an extremely rare discounted price, and then it's probably going to return to its typical stability somewhere between $12 and $15 most likely. Next up, we've got ETY. This is also quite similar to ETV. It's also an Eaton Advanced fund, and as you can see here, this is actually a high-yielding stock that survived the 2008 crash, and pretty similar story as ETV as well here. Once again, getting in at a discounted price compared to what's typical. So also nice opportunity. I like this one a little bit less than ETV, to be honest, but it is a bit of a diversification. And like I said, this one is a pretty similar story as ETV. If we look at the fund itself, you're going to see that it is trading right now below the net asset value once again. If you look at this one, most of the time, the market price is significantly higher than the net asset value. And like I said, it's actually very rare for these type of funds to be able to get in when the market price is below net asset value. So although I haven't bought any of these yet, I will be buying them in the coming weeks, and hopefully they don't go too much up by then. Once again, keep in mind that these videos are not financial advice. Let's take a look at a stock here. This is a Wright stock, and I feel like this one got completely unfairly hit during this drop. If we take a look, very strong performer for years, since 1980. It had a couple ups and downs, but it's always recovered very well, and the drops were pretty minimal. The worst one being around 2008, where it dropped 42%. If we look at the current drop, we dropped 46%, so we can expect to bounce really any second here. And if we look at the real estate that they own, they mostly invest in senior housing, assisted living, memory care communities, post-acute care facilities, and medical office building. So typically nursing homes and stuff like that, which aren't going anywhere, even in a recession. And that's why when I see a stock like this that's in that type of industry, I feel like it's a complete steal, right? Especially with this 46% drop that we just had. I mean, like I said, their business model isn't going anywhere, and these ones pay monthly, very strong yearly dividend of 7.54%. But like I said, it is paid on a monthly basis, so you need to divide that by 12. Now, let's take a look at the next stock. This is going to be PDY, which is a PIMCO Dynamic Income Fund. It is at a strong yield of 12.45% right now. Typical past performance, very stable. Obviously had its first very big drop here, but like we're seeing with a lot of these other stocks, we can expect a bounce. And if we go and look at some of these stocks, right, ETV, I mean, it's typical for when we have drops like this to bounce back at least to the white Bollinger Band, the middle Bollinger Band line. And let's take a look at PDI, see what's happening. For the most part, you're going to see a very similar pattern across all these charts. And like I said, what do we see? Exact same thing. We haven't even hit the white Bollinger Band line yet, which is at $25. So that's something that I expect very shortly, probably within the next month, month and a half, to get back to that white Bollinger Band. Then we might see some consolidation, but already getting back to that white Bollinger Band is usually pretty much guaranteed in this type of situation. Can't get much of a better opportunity than that. I mean, the sign's already there that we're going to see the bounce. You know, we already are seeing a V-shaped formation. We just broke out of the downtrend line on the RSI. We're curling back up on the MACD. This is the perfect setup, and these don't come that often as well. So that's something I have to keep in mind. And just to get a visual idea of what I'm talking about with those monthly dividends, if we go over to dividend.com here, you're going to see exactly what I'm talking about, where these dividends are coming in on a monthly basis, right? You're literally making passive income just by holding these type of stocks. And like I said, they're in very long-term stable business models with senior care housing, and it doesn't get much better than that in my opinion, right? So really like that opportunity. One more stock that I wanted to add to the list is SPHD. This is actually an ETF that is a compilation of the 50 highest paying dividend stocks in the S&P 500. So there is sort of a safety aspect behind that. Typically a very stable and just slow and steady dividend pays every month. Obviously got a big drop because a lot of those S&P 500 stocks fell, but these are for the most part, kind of blue chip companies, long-term companies, and they should rebound fairly easily, especially on a longer term time frame. This is actually one that I bought during the drop, and it's starting to turn into the green, my position. Now, if we look here, you can see that it is a S&P 500 high dividend, low volatility ETF, specifically as you can see here, it's composed of 50 securities in the S&P 500 index that historically have provided high dividend yields with lower volatility. And here we have a little bit of a short list of some of the holdings, including Iron Mountain, one of my favorite stocks. We've got AT&T, just a lot of very strong blue chip dividend stocks here. And that's exactly what this ETF is. That's why it has a historical, very stable, slow and steady upward performance. Finally, last stock, a little bit of a hidden gem that you might not know of. This is actually a Russian stock, so maybe a little bit riskier, but it is a mining company. These ones have had a very strong performance recently in the last couple of years. This is an OTC stock, and if we look at the previous performance here, it pays a very big dividend of around 11% and also goes up pretty steadily over time. Now, here we have a very big discount opportunity with the recent drop. It already bounced though quite a bit, but it still has some room back to the all-time highs. The one thing that I don't like about this company is the fact that its dividend payment is only once a year. So that is a pretty big downside depending on how you look at it, but there is an opportunity here to get in at a cheap price with that strong dividend, and it's also a bit of a diversification as well. With that being said, this is the end of this video. Thank you so much for watching. Make sure to leave a like. Also, don't forget to check out my Twitter. I've been very active on there, updating the markets in real time, so make sure to follow me there if you haven't seen it yet. And also check out my technical analysis master course. This is the ultimate guide to technical analysis. We got great reviews, less than $20, and a 30-day money-back guarantee, so you've got nothing to lose by giving it a try. Thank you so much for watching, everyone, and have a great day.